From small businesses to global supply chains, inventory control can make or break a business's profitability. Let's look at how the best in the business do it right. How's it going? This is your Supply Chain Pro here, and in today's video, we will be reviewing the fundamental principles to successful inventory control. Every company in the world that produces physical goods for sale must have some sort of inventory control program. Inventory control in its most basic form ensures that the physical items owned by the company are accurately reported and accounted for. Let's use an example where a company produces for sale pencils. In order to produce the final goods, the company must have an inventory of raw materials to create the pencil. If it is decided to produce 1,000 pencils for sale based on customer sales demand, there will need to be 1,000 of each of the raw material components available before production can begin. This pencil is composed of wood, graphite, paint, the metal clasp, and rubber for the eraser. In order to make the 1,000 pencils, the company would need 1,000 of each of the raw material components. Let's say the company has 1,000 of all the components except for the graphite. If the company checks its record-keeping system and the system says it has 1,000 units of graphite, however, if the company physically only has 500 pieces of graphite in storage, we have our first inventory discrepancy, and the company would not be able to complete the production of the 1,000 pencils as planned, since the graphite is essential in the function of the final product. Or, in another scenario, if there were only 500 rubber erasers and the full 1,000 units of the other components, the pencil could still be manufactured. However, half would be missing one of the pencil's beneficial functions, and the end consumer may choose a fully equipped pencil with an eraser over a less sophisticated pencil without. So this turns into a customer satisfaction issue if producing 500 pencils without erasers. Inventory accuracy is essential in all aspects of the business world. Let's begin with the most basic of definitions. A stock keeping unit, or SKU, is a unique identifier for each distinct item in inventory. Other synonyms for this include the product code, item number, and many other variations across the world. This stock keeping unit is how the system thinks or refers to a single item. You may only have one unit of this item in your system, you may have 100, or you may have 10 million units of the same item. The moment that you have a second item that is fundamentally different than the first item in your system, you will have a second and different unique SKU. Items being produced can be further given another identifier to group all of the same product produced at the same time. This term is often referred to as a lot or a batch. If there was something wrong found in Monday's production of a product, having a unique lot or batch identifiers each day allows the company to isolate only that single day's worth of inventory. Lot and batch codes further complicate inventory storage, however, can lead to additional financial retention that we will explore later in the video. Another fundamental concept to inventory control is understanding the unit of measure of an item. Using an example, let's say you work in a factory that produces screws, and one screw is called one each. After production, your company places the screws into packs of 100 screws for sale at the hardware store. This can be referred to as one retail unit. In order to properly package and ship this product to hardware stores, your company places 25 bags of retail units into a single box for storage and transport. This is referred to as a case. To be clear, there are 2,500 single eaches of screws in each case. If you work in the inventory or the order planning departments, it is important to understand the unit of measure you are working in. If you're ordering 25 retail units, that would be one case, or 25 cases. A misunderstanding in the unit of measure can lead to huge variations in inventory counts and order completion. Another fundamental principle of inventory control is counting verification. Companies in the 20th century used to store their inventory records in books and binders on paper. Manual physical records are a thing of the past or only used in the most simplest of business applications today. Almost every modern company uses some sort of electronic system or database that houses information on its inventory. Counting verification occurs when an employee goes to the physical spot where the inventory is housed and reports an account of what they physically see. If the account matches what the record in the system says, great. If the account doesn't match, there's an inventory discrepancy, and the counter should adjust what the system record says to match the physical. The most basic principle in counting verification is making the system match. Basic counting verification can be broadened out to include larger groups or segments. This is called cycle counting, when you count all of the locations of a single item, an item type, or a region of the building. Cycle counting is a technique that is used in two ways. The first is used to solve tomorrow's inventory discrepancies and customer order quantity issues today. The second purpose is to validate financial ownership amounts for corporate processes. Another common principle in the inventory world is that of FIFO or FIFO. FIFO stands for first in, first out, and FIFO stands for first expired, first out. Both terms are used to determine the shelf life where companies should ship their oldest inventories of a product first. First expired, first out is oftentimes used in the food or medical industries with products that have expiration dates. This is used as the tool to prevent product from going stale or spoiling before it reaches the end consumer. Stales and spoils have a financial loss associated with them. Not only was there no sale to bring in revenue into the company, but there was also a waste of the financial cost of the raw material ingredients and labor steps of the supply chain just to throw the product out due to poor inventory rotation practices. Inventory management is built on logic. The inventory will never create a lie or treat you with disrespect, and approach inventory management with a sense of logical cause and effect will help you as you navigate through these problems. Reconciliation is an inventory management term used to explain problem solving, which is engaged when the physical inventory does not match the system. There are many logical techniques and best practices that can help find root causes for inventory discrepancies. One example is if you're over by 10 units in one location, there is a certain probability that you're short by 10 units in another location, and those 10 cases were mistakenly taken from the wrong location by someone doing the work. Another example is if you have a physically empty location that your inventory system says should have product, there is a probability that the missing product was put into another location nearby incorrectly by an employee doing the work. Check nearby locations that are empty in the system. There's a certain probability you will find your missing product. Some electronic systems hold additional transactional information that can further allow problem solvers to piece together the context surrounding an inventory discrepancy. Some of the system information includes employees who touched the product, locations where the product came from, time and date information, batch or lot code information, and a variety of other pieces of data. Good inventory reconcilers can use this information to reconstruct the series of events that led to an inventory discrepancy and allows you to discuss with employees who had a role to play in the process to understand what they saw or remember as you try to piece together what happened. A significant influencer of inventory accuracy will be the quality of the source of how the inventory gets into your system. In the two traditional ways for inventory to be created in a receiving or inbound department, or at the conclusion of a production department, the accuracy of these sources will play a huge impact on the accuracy of the remaining steps in the process and how easy it will be to perform reconciliation. If these two sources are historically correct, you can rely on them as you try to piece together the series of steps that led to a discovered inventory variance. If these two sources are historically inaccurate or sloppy, you begin to question if the inventory was correct upon entering the system in the first place. A trace exercise is an inventory function in which a specific product or pallet can have its past movements tracked throughout the electronic system. Traces are important to understanding where a pallet or a batch of product came from, the steps within your facility, and where the pallet or a batch of product shipped out to. A recall is a situation where there is something that was produced that is dangerous to the end consumer. Think about E. coli bacteria in the food, or a bad batch of medicine. In the event that consumers get sick, a recall of that item and batch may be initiated. A comprehensive trace must be conducted for all units of the affected product and batch or lot. Retailers and consumers must be notified, and any unsold inventory must be put on isolation hold to prevent further risk of injury to the end consumer. Products needing to be recalled are either destroyed or reworked based on the specifics of the item in question. There are all sorts of different types of complex inventory practices across the world. Comment down below if you work with a more complex practice or would like to know more about one. Inventory departments are oftentimes bundled underneath the finance department at an organization. See a separate video on the channel for more information on the structure of an organization. Having correct inventory means having correct finances. If a company has poor inventory accuracy, the financial cost of the missing inventory must be accounted for somewhere. I want you to think about your phone charger. You may have 3 or 4 phone chargers spread out around your house to charge your phone whenever it is convenient for you to do so. In the event that 2 or 3 of your 4 total phone chargers were to go missing, it would have a negative impact on your convenience to charge your phone. In order to easily have access to charge your phone again, you will want to find your lost phone chargers, or you may seriously consider purchasing 3 new ones so you can easily charge again. The cost of the replacement phone chargers is due to inventory inaccuracy and must come out of your home's budget. The same principle applies to inventory management. The cost of any missing inventory must be accounted for and will eventually come out of the company's financial budget. Ultimately, having accurate inventory allows for both company profitability and customer satisfaction. If customers are placing orders because they see you have available inventory in your system, and if you are having to cut customer orders short or delay delivery due to missing inventory, ultimately your customer will be dissatisfied with your service and may choose to go to a competitor where they can get their deliveries on time. Hopefully now you know more about inventory control principles and are ready to use your new knowledge at your job. If you found value in the content of this video, like and subscribe. This is your Supply Chain Pro, out.